If you bank with Wells Fargo, you have to hear this. Wells Fargo has left ESG Project Finance Group. This means that they are no longer using Equator Principles, which is a benchmark for determining, assessing, and managing environmental and social risk in projects. Since they're no longer a part of this means they're no longer necessarily having to adhere to these practices, which essentially means that as banks have our money, they're taking that money and they're investing it. This is why we actually have fractional reserve banking. It means that instead of keeping all of the money that a bank has, they take part of it and they go out and invest it and try to earn more money. They give out loans, they invest in things, they're earning more money. They're actually earning a ton of money on our money and barely giving us any interest. If you know anyone who uses Wells Fargo, be sure to share this with them. Now, the problem with them no longer being a part of ESG is that they are now funding their money into who knows what. And as of March of 2020, the Federal Reserve eliminated all reserve requirements. So meaning now the banks don't have to hold anything in reserves. They can go and lend it all out. This is actually why banks have to be insured by the Federal Deposit Insurance Corporation, because it insures our money, because banks they work on ratios. They generally keep a portion of money, they loan out the rest, and if they don't make returns on that money, then they actually have to ask the FDIC to bail them out, and the FDIC insures up to $250,000 for every single person who has money in that bank. If you have more than $250,000, you're not going to get a penny more, but if you have up to $250,000, you'll get that money back if the bank has to close down. We've had banks close last year because they over leveraged. They actually lend out too much money. They were no longer solvent. They didn't have the money to actually pay the people who deposited money into their bank, so they had to ask the FDIC to bail them out. And since 2000, there have been over 500 bank failures, meaning the FDIC had to step in and pay the people who were putting money into those banks to give them their money back. So if you are banking with Wells Fargo, especially if you have over $250,000 in the bank, and actually you should never have more than a month or two's worth of bills in the bank, and if you want to know why, see if you qualify for a free financial strategy session. We'll go over the whole thing. But if you are using Wells Fargo, they're no longer standing by these principles, which means they could be funding that money into anything, and they may or may not get a return. And if they don't get enough returns on their money, they may have to have the FDIC bail them out. If you have the majority of your money just sitting in a bank account, see if you qualify for a free financial strategy session with me and my team. Your money is earning you next to nothing in interest in the bank, while the bank is earning money hand over fist on your hard-earned money. Wouldn't you rather have that interest going to you instead of the bank?